Oh, certainly where we're seeing a lot of activity, and I think it's partly because, especially as the banks can't put capex into the hotels, but also their range of options is more limited because even if they might otherwise consider some sort of warehousing structure, they can't bring the employees onto their balance sheet. So they're more inclined, I think, to try and reach resolution on those sort of situations. They seem to go through a process where there's an initial write-off of equity, a re-incentivisation of the management when it's sort of run for a period, and then there's an exit. So I think there is a lot of activity there. Really.
Okay, good.
I think there's some interesting health warnings in markets though. You look at Holland, where we manage about 4 portfolios, $500 million of assets in Holland. And on one of the slides was the TPG Patron Uninvest deal. And, a lot of Dutch real estate is now trading at sort of 12 to 15%, net initial going in yields. But, if you really start scrubbing the market, there's probably a reason for that, which is, the Dutch market is sort of structurally under-demolished.
But do you think that's got to the level now where that's good pricing based on the risk? I mean, because we've seen people now begin to look at
absolutely, David. So you get American buyers thinking, wow, look at these net initial ingoing yields we can get in Holland. These are double digit, these are fabulous. Buyer beware. And then in Germany, we had in sort of 05, 06, 07 a lot of Anglo-Saxon funds, businesses buying German retail. So there must have been, 5 to 6 to 7 billion of deals done on the sort of yield arb, because people could see yields just getting unsustainable in the UK, so they went to Germany. They didn't really know much about it. They bought a lot of German retail kit. A lot of these were highly levered. They sit with the banks, and German retail is difficult to understand. You're not getting the sort of 5-year upward-only rent reviews that you can get in retail in the UK. It's a completely different, model in terms of indexation, and so that's just 2 pools of interesting opportunities. Sort of Dutch, more generally, German retail specifically, where there's a lot of activity, but and the yields are high and they look attractive, but actually you've really got to do your work in terms of what else is going on in those markets.
I think in Germany, I think what we've seen more asset-specific situations and portfolio situations. And I think because the German banks' sort of cost of funds from the government funding is so low, and because of their sustainable valuation perspective, I think there's going to be far less sort of portfolio-type deals. Obviously, unless you've got a non-German lender, such as on the Chamonix portfolio. But I think where there is a portfolio, I think there's a view that there's more potential for mispricing in the local markets, where it's easy to ignore the impact of a local investor funding itself through a local Sparkassen bank or Landesbank, where, although it's not a very large property in the context of a more limited investment area, it's an important property.
I mean, we've looked at a lot of those sort of 100-odd million secondary retail, Lidl-anchored. It's a nightmare. It's basically the summary I've come to. Because frankly, this shed costs nothing to build. There is significant oversupply in these markets. A lot of the pricing was based on reasonably long weighted average lease lengths, which are all but gone. And the gross to net, to come back to your point on yield, I think a lot of these investors went in with a UK view on property management. And an absolute horror show happened that they realised that 25% gross to net was actually not pretty reasonable. There's not usually money you can do about that. So you end up with a value problem, a cash flow problem. Frankly, an oversupply problem.
And also,
as you can tell, I'm not convinced this is the best opportunity.
No, absolutely, it's very interesting.
Caps on indexation as well, really, so you can't get the full, even though
it's really hard to make money.